I'm Eric Birch from miningclips.com with your weekly market debrief. The rough start to 2016 continued this week with major indices giving up more ground. In fact, it's the single worst start to a year for stocks in history, with lack of global growth and oil price deflation driving selling. China's Shanghai Composite has now fallen over 21%, along with Europe's STOXX 600 declining over 20%, sending both indices into bear market territory. In Europe, over 1 trillion euros has disappeared from the marketplace since the beginning of the year. North America has fared slightly better, and according to Bloomberg, both the DOW and S&P have posted close to a 9% decline, the NASDAQ down 11%, and the TSX lost almost 8% this year. Oil hit yet another 12-year low this week, falling under $30 a barrel, a level not seen since 2004. With U.S. inventories at 483 million barrels, crude inventories remain near levels not seen for this time of year in at least 80 years. And with Iran set to add another 500,000 barrels per day to this oversupplied market, now that economic sanctions have been lifted, I expect oil to remain under pressure for some time. In metals, gold held its own this week, closing at $1,088, a small decline from last week's close of $11,001, and silver saw little movement, ending down 2 cents on the week at $13.93. In copper, we did indeed fall below the $2 level, ending the week at $1.94. On a side note, a BNN interview this week revealed that copper consumption from Western economies is actually down by over 1% over the past decade. The driver for copper has been emerging economies, specifically China, which recently accounted for 40% of global copper consumption. And now that their economies are slowing and moving towards a more consumer or service-based model, copper prices aren't expected to move higher anytime soon. Ultimately, we need to see oil price and Chinese currency stabilization, and for that to happen, we need to see some good news in the global economy. Jason Gobford of Sentiment Trader commented that the indices have had 2 10% corrections in a rather short span. That has only happened 3 times in the last 100 years. Unfortunately, those occurrences were in 1929, 2000, and 2008. As you may recall, those were not particularly good years for the bulls. These are uncertain times, and the markets are definitely reflecting that. For miningclips.com, I'm Eric Birch.